The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, if you're a long-time investor, even if you're a short-time investor in the markets, you probably are familiar with the terminology of whipsaw, which
Right.
basically you think things are going one way, and on a dime, it turns around and goes back against your assumption. And that is basically what it appears Mr. Powell did in his presentation last week. This is one of the regular Fed meetings, and his normal period of speech and Q&A that follows last Wednesday basically said, we think we're on track, and oh, by the way, we think we're not. Well, those weren't his exact words.
Perfect Fed statement then. Yeah, we're not really going to say anything. Why don't you guys decide what this means?
So after a two-day meeting, the chairman is typically expected to come out and explain where things are going. In what I'll refer to as the olden days under Greenspan, it didn't matter what he said because he was so confusing in his speech that it was nicknamed Greenspeak, and people would spend a lot of time trying to figure it out. After Bernanke, Mr. Powell said, we're going to opt for transparency, try to make things a little clearer about what we see coming down the road and what we intend to do about it. The theory being, we don't want to surprise the market and really upset the apple cart.
Right.
After all, it's kind of an admission that they are political animals. Some of that was done before Mr. Powell knew he was going to be reappointed as chairman.
True enough. But now, like I said, now with transparency, everybody wants to get their 2 cents in. So now instead of trying to parse just the chairman's words, we're parsing everyone's words. So we'll have 5 different people that came out and say something, and it's like, okay, so now what did they all mean? And it tends to make things a little grayer, in fact, instead of more black and white. But that's where we are.
So after him speaking on Wednesday, you had a speech, I forget by whom, on Saturday, and then you have Williams and Barkin making speeches on Monday, and you have another one on Tuesday. So everybody's going to get a chance to express their opinion and totally muddy up the water about whether or not rate cuts are coming this year or next. Fact is, the Fed isn't even apparently too sure about it right now. Since inflation rolled in a lot hotter than they expected.
They definitely said that they're not making progress toward their 2% inflation objective. That's what they want to see. That, in their opinion, has stopped. So we had some good inflation numbers rolling in there for a couple of months, and now that has slowed down, and so now we're back much more to the mood that, well, the Fed is 100% data dependent, and it's going to depend on what the numbers are next meeting, whether we're going to get any relief on the interest rate side or not. But it does show probably they're pretty serious about this 2% inflation objective. They want to see 2% inflation, and we're not there yet. And now we've stopped heading that direction. So they really are saying we're not going to cut rates in this environment.
Well, if you annualize the quarterly PCE data that was released last week, you end up with an annualized rate that's in excess of 4%. That's not anywhere close to where they want to be. And we as consumers and citizens should be saying, why 2%? Why can't we go to 0? And why have a built-in removal of our purchasing power?
Why is that the objective? Yeah.
mean, I would like to keep my purchasing power constant through my lifetime, and that certainly has not happened. And a good portion of what we see in real estate values and stock market values and the price of precious metals isn't real economic growth. It is the inflationary pressure that has
Yep.
been uh, constant throughout the last 4 or 5 decades. Let's just basically since the 70s. There's been no real significant relief, and there's no backtracking. That's a problem for millennials who've never been through a period like this, who are thinking the Fed's going to get this back to where we were before the COVID deal showed up.
Right.
And that's
Right.
highly improbable. It's just simply not likely. You mentioned that the Fed isn't where they want to be. There's a quote here from Mr. Powell. It says, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. So right
Yeah.
now, the federal funds rate, the interest it pays to banks on their reserves, the overnight deposits, the primary credit rate, it's all in the 5
Sure.
to 5.5% range. And that's just simply not going to change. Now, the bond market, on the other hand, is basically saying, liar, liar, pants on fire, you're going to cut rates. They
Right.
don't believe the Fed.
Right. And for the longest time they were on the Fed's back because inflation was quite a bit higher than the interest rate. So when inflation is running at 8% and your interest rates were at 4%, how is that going to help? That's not, we're not slowing this economy down. So now interest rates are at 5%, and like you said, Don, the annual percentage increases in inflation are around 4%. So the Fed's opinion is, look, we're on the downside of this. We're just having a stall right now. So it's not an appropriate time to let up the pressure. We're not going to cut rates right now, but we think we're on the right side of this. So we're not going to increase rates either. And right now that seems to be their opinion. And it's probably true. Going slow here is better than declaring victory and starting to cut rates too soon, because we still have rampant consumer spending. You and I are out there spending like crazy, and that says to the economy at large, we're fine with the inflation. Inflation's up, prices are up, we're still paying it. So that gives companies zero incentive to cut prices on anything. It's like, you're paying it, we're charging it. We think the system works just fine. So we're happy to let this run also. So just letting this run for a bit may be the Fed's best move.
Well, the inflation is being driven by wage increases at this point. People, what you just referred to, people are still spending money because they're getting pay raises. They're becoming a little more cautious about what they spend.
Yes.
And that's evidence with the big sell-off that happened with Starbucks, because they missed their earnings and revenue numbers much more than anybody ever anticipated.
Including them. Yeah, they were quite surprised.
Including them. And the former CEO, Schultz, tweeted, what do you still call an X comment a tweet? I don't know. I'm confused. What do he exited?
Right.
So he wrote on X that the
coin that.
management.
Yeah, you got to coin that phrase.
He wrote on X that the management at Starbucks should get back to their core business and basically quit fooling around. But I looked at the stock, and it's been down for it's been trending down for a couple of years. It did get a rally, but it rallied back up to the downtrend line. And all this selling off that happened last week was just an exacerbation of the continuing problems that have been evident for a couple of years at Starbucks. But people have decided that they're unwilling to pay whatever it is that you're paying it for, $5 or more for a cup of coffee that's got sugar water added to it. And they're doing something else. But they're not alone. I mean, eating out as a family, that often includes McDonald's or KFC and some of the other fast food restaurants, and they're also seeing a downturn in their tickets, the frequency, the total sales there's some pressure here on the consumers because inflation is
You bet.
persistent. Then if it was back at 2, and better yet, if it was below 2, we've briefly had some periods of below 2 inflation. I believe we did back during COVID. Didn't last very long.
Right.
But that's basically because we weren't spending on services, and our discretionary spending went on um, hard goods, remodel your
Stuff.
house, put in new
Right.
appliances. It's time to buy tires for the car. I mean, let's get some of this stuff done that we've been ignoring because we can't go anywhere anyway. We'll get prepared for when we can. And now we have services inflation, and that's easier to do. In fact, we did a podcast recently on YOLO. You only live once. Quit buying goods and go create an event that is memorable. Make memories
There you
and
go.
and document it so it goes up on TikTok or YouTube or someplace that you can, your Facebook page, where you can share it and show everybody how exciting your life is. And that's keeping inflation up with some discretionary dollars. But even the discretionary sector has pressure on it for maintaining revenue right now because people's household budgets are getting pressed. Rates do need to come down, but let's see, who was it that was out? Fed Governor Michelle Bowman was out on a weekend speaking bout, I guess, spree. And her comment was that while she's willing to raise the federal funds rate at a future meeting, the incoming data would have to show progress that inflation has stalled or reversed. So that has left the marketplace with, does that mean they're going to hike rates? That doesn't look real likely. And in our webinar on Saturday, we had a question about whether or not the Fed would raise rates. I said, we don't forecast this stuff, so what we have as an opinion is worth what you want to pay for it. It may not be
Right.
very much, but
Right.
my opinion is that the Fed is probably going to be forced to cut rates because of the massive deficit spending that Congress is doing, and the cost of financing our federal debt is going to become overly burdensome. And the way to deal with that is to shut down or lower interest rates. And this week is going to be a tell on that because the Treasury has, I believe it's 68 billion. They've got 68 billion in 3-year notes. They have a bigger number in 10 and 30-year bonds that they have to fund. And if the buyers don't show
Gotta
up for
move.
that, it's going to raise rates. And you raise rates on the fixed income stuff. That means the bondholders have more income to spend. That's an inflationary pressure. But the Fed didn't cause this inflation. Congress did, spending money they did not have, with no plan on how to pay it back. It's just, well, we just print money. Well, that's not inflationary.
I'm pretty sure that's written down somewhere in Washington. Yeah, we don't need a plan. We just print money. That's what they do. So they're very consistent. So that's definitely their plan.
And there are a few congressmen who have said basically they didn't think that printing money was inflationary. Those are the
Right.
same. Those are the same ones that were in the pass no pass econ class.
There you go.
They did
There you go.
just enough to get by.
Uh,
So we don't see any real change in this, but the markets are responding to it by saying, well, the Fed has to cut rates, therefore um, stocks can go up, bond values can go up because rates are going to go down. We get a rally. And I spent the weekend looking at charts, which is my normal process. And it's interesting that the indexes are really disconnected from what's going on with the underlying stock market, the broad base of stocks. Because the
mhm.
indexes are much more easily manipulated by the dark pools, the algorithms. You get into the smaller mid cap companies, the small cap companies, not enough volume for those to push around and make any real big
Move it.
difference.
Sure.
But the indexes are up against what is, in technical terms, called resistance. They're going to have to break through prior highs and be able to sustain that. And if they can't, then the argument that interest rates are going to fall before the end of the year probably will dissipate. And we are in the seasonal period of the year, May go away and wait until October to buy, which is typically rocky. Now, May go away does have a discount factor, and that is during presidential election years, May and go away has a high percentage of actually turning out to be a higher return by the time you get to October.
Mm-hmm.
How much? Well, that varies depending on which presidential election you look at.
Right.
And frankly, the Democrat elections generally create better markets. That's because they spend tons of money that they don't have. And the Republican markets are, we would like to see our border sealed up. We'd like to see some of the social unrest problems resolved and stopped, and vote in Republicans, which probably means fiscal responsibility. Somebody has to figure out how to pay for all this garbage we've been buying, or committed
Sooner or
to
later.
spend money on. You know, spend
Yep.
money overseas and no plan to get it back. Yeah. Why worry about it now? This is a Alfred E. Newman event. What? Me worry? No. I'll let the next election round worry about that. I'm not going to be here. Politics is as usual. Anyway, you want to talk about your particular portfolio and the investment decisions you're making, you can give us a call. We'll be glad to chat with you. Contact information and email is on the following screen. If you haven't signed up for our webinar, we have a link on our website. And if you want to listen to the one we just did, there's a link for that too. Have a great day.